like to thank David for a superb job at risk management. We had 503 people registered for tonight, and as you can see, we have 200 seats. So arranging that storm and the resultant subway problems was really quite talented. My name is Leslie Rawl, and I run a company called Capital Market Risk Advisors, and I've been a board member of the IAFE for 15 years now, so one of the early participants in this organization. I'll introduce our illustrious panel after I take a moment to set the stage. I'm sure for most of you, it's no surprise at this point that something's been going on in the subprime mortgage market. And here you can see the ABX contract for triple B for the cohort group of the first half of '07. And yes, there was some news in March and April, and we had New Century, and there were some things beginning to happen. And if you read the statistics carefully, or if you read the press carefully, you knew something was happening. But starting at the beginning of June, and then exaggerating in later July and into early August, as everybody now knows, a lot happened. At the same time, credit default spreads have begun to respond. And I don't mean to pick on Radian. I hope there's no one here from the audience who takes personal offense. But as an example, here are the credit default spreads since April on Radian, which is, as I'm sure you know, is a monoline insurance company. And if I put any of them up, or I'm afraid any of the financial institutions that many of you work for, you would see similar patterns. So something is going on. Now, I think it's important to remember a couple of things. First of all, subprime loans. What are they? They're loans made to borrowers who have less than acceptable credit ratings for prime rates in the mortgage market. In addition, most of them are on an adjustable rate basis, and an unusual structure for adjustment. They're 2s into 28s, which means there's a teaser rate set for the first 2 years, at which time it resets into a fixed rate. Unfortunately, the credit decisions in general that were made on these loans were made based on, could the borrower afford that first 2-year stub, with full knowledge that there was going to be a rate reset and the teaser would go away. So you have a fundamental problem in how these loans were originated. I believe that as time goes on, we'll find that there's more and more fraud and bad acts involved, especially in some of the brokerage areas where people were using self-reported definitions of income and self-reported valuations on their home to even qualify for that 2-year teaser rate. So I think there's going to be a lot coming out over the next 6 to 9 months as to what was really going on. But the real thing that seems to have precipitated this crisis is the structuring of those assets. Yes, subprime is having a problem, but what's really spooking everybody is that those subprimes have been sliced and diced, as we financial engineers like to slice and dice things, and put into securities that have ratings that are very high and represent credit worthiness if held to maturity, not mark-to-market volatility. And it reminds me very much of the Orange County days. I was actually called in by Orange County a month to the day before their bankruptcy and asked to take a look at their portfolio and tell them what the impact of a few margin calls was going to be on their yield. I swear that's the question they asked. And when you really began to look at their portfolio, 95% had a final maturity of less than 3 years and was AAA rated. But it had a 17-year duration. It had a triple D volatility. And they didn't have the staying power or the cash flow to sustain those mark-to-market losses. Also, they weren't marking to market. And I'm afraid we're also going to see that in this current crisis is an awful lot of this paper is held by people who account for it on a hold-to-maturity basis and who don't have to mark to market unless and until there's an official downgrade. So I'm pretty pessimistic, although some of my panelists are less pessimistic, and hopefully we'll have an interesting conversation. I'd also like to show you one other chart. Now, this is a very busy chart, but I didn't have time to simplify it. But the part that I want you to focus on is just right here. 99, middle of 98 to 96, to 06. And this happens to be the percent of metropolitan statistical areas that had year-on-year declines in home prices. Had year-on-year declines in home prices. But it doesn't really matter what it is. It's just as financial engineers, as statisticians, not everyone in this room is, but I know a lot of you are, how you think about these markets is going to be very dependent on what perspective of time you might have. So if you were looking at this whole period of time, you might think that the probability of housing prices bouncing around is significant. However, if you were only looking back on this window, you might think that housing prices only go up and everything's dandy. So with our ways of using shorter horizons, because that's all the data we have, and then weighting those statistics where we put more weight on more recent occurrences than older occurrences, you can very easily see how people could convince themselves of that we're in a very benign world. The last comment I'd like to tee up as we begin is something that I've always liked from The Odd Couple. Now, most of you in this room were probably too young to remember The Odd Couple, but it was a wonderful show on Broadway that became a wonderful TV show. And Felix, who was one of the characters, did a wonderful presentation one day on the word assume. And he wrote the word on a blackboard and then went up and parsed it. Now, this has always been and continues to be my concern. And I love financial engineering, but inevitably we make a lot of assumptions when we build these structures. And these assumptions always end up getting us into trouble when reality doesn't meet our assumptions. So the stress testing of assumptions is something that I think is a real lesson to be learned from this current crisis. So the title of this panel is something like, is subprime the canary in the mine? And I would put forth that we'll come back to that at the very end, but that it probably, in my opinion, is a canary in the mine, but it's a very hardy canary that is dying very slowly. And we know we had that, we've been knowing, it's 6 months now we've known we've got a problem, and we're just beginning to see. So if this is the canary, we can only imagine what else we're going to find out. Now, as David alluded to, because we have a large audience, we've passed out cards. And rather than raising your hands and with questions, if you have a question, if you just write it on the card and pass it to Amy, she'll be funneling them up here, and we're definitely interested in your questions. We'd like this to make this as participative as possible, but it would really help keep the flow if you give them in writing. And one last item before we introduce and start the panel is, I'd like to just sort of take a show of hands. We talked about credit default swap spreads being sort of a mirror now of credit worthiness or lack thereof in the environment. And we showed at least one company, and I think you'll all accept my statement that this has been a generic problem, particularly in the financial services arena. But I'd like to know how many of you think credit default swap spreads are going to be higher at year end, and how many think they're going to be lower than they are today? So can I have, first show of hands is for the higher. Okay, lower. That's what makes markets. It's about 50-50. So, yeah, interesting. Interesting. Well, I'm of a higher school, but I think we have some lowers.
Financial sector.
Yes, okay, financial sector only. Let's do that again. Higher. Lower. Okay, pretty similar. Pretty similar. So with that as a backdrop, I'd like to introduce our panel. Their detailed bios are in your program, and I'm sure many of you know many of these people as their leaders in our industry. Rick Bookstaber he and I have been around forever, and has just written a wonderful book, which I encourage you to read, A Demon of Our Own Design. Alan Maltz is the Clinton Group, which is a mortgage-backed hedge fund run by George Hall and used to be at Rismetrics. Francis is at the credit strategies area here at Merrill Lynch. And Henny Sender is a journalist for the Wall Street Journal who's done a wonderful job over the years following some of these kinds of issues. And I thought it would be interesting for all of us to get a journalist's perspective. So with that, I'm going to ask each of the panelists to give us, just as I have, a few minutes of their perspective on the world, and then we'll ask each other questions, and you can ask us questions, and we'll see where it takes us. So do you want to start?
Thanks. If you've read my book, you probably know that I'm more of a pessimist or a bear, which probably is suitable given that a lot of my career has been in risk management. There's actually a journalist who's going to be writing an article where I may be one of the people he talks about in it, and he calls it the catastrophists. So that sounds to me better than bear or pessimist. So I guess I'm going to paint maybe a worst case scenario for this, where indeed this would be a canary in the mine. Although let me start by saying, to me it's heartening that there's enough concern now that we're seeing spreads widen the way that they are, that this many people come out in the middle of August for a talk like this, and that we're seeing so much volatility in the market. I think now people are starting to focus. The Fed sort of is not exactly leading the pack on this, which is somewhat disturbing to me, but I think people are registering concern, and if that leads to wider spreads, if it leads prime brokers to be more discerning in how they provide leverage, and if it leads people to back off a little bit in terms of complex instruments, then we might have some pain for a while, but in a way that will reduce the prospects for what could be, I think, a major systemic crisis, which could be the other hand of this. The thing that I am concerned about, and I do believe that what we're seeing with the subprimes is just an indicator of the same sort of thing that is occurring or can occur with the mortgage market generally. Because basically, structurally, the mortgage market and the credit market also, for that matter, have the two components that I discuss in my book as being sort of central to creating market crises. The first thing is leverage. And here, I'm not just talking about the leverage that the financial institutions or the hedge funds might have, but also the leverage of the homeowners, many of whom have really borrowed to the hilt, sometimes misrepresented themselves, thinking maybe that they'll get a better job by the time the arms kicks over, or they'll sell the house and post a profit before the pain gets too great. But of course, if the market goes the other way, then they're stuck in a situation where they have to somehow try to make do and make the payments. The second thing is complexity. And complexity really, is basically derivatives and financial innovation. And the reason complexity is difficult is this point that we see with some homeowners, that people may not really understand the implications that exist in the instruments they have, and even professionals may not fully understand the potential perturbations of events that could occur based on some of the subtle characteristics and nonlinearities of the instruments that they have. And mortgages have, if you're looking any place, mortgages are probably the place that you'll find the most complexity and the most leverage. It's interesting with Bear Stearns, I don't know what the leverage was for the hedge funds, but they basically had instruments which arguably you could say had 5-to-1, 10-to-1 leverage. And from what I gather, they then levered in those instruments on the order of 5-to-1 to 10-to-1. So, they basically could have had leverage anywhere between 25 and 100-to-1. Did they really recognize that? Did they think that the instruments that they're holding were not themselves levered? I don't know. But the problem with this leverage is that you can get into a liquidity cycle where basically what we saw with Bear Stearns, and then it was sort of thwarted through the banks stopping the mark-to-market process of the instruments that were under pressure. But you basically are forced to sell. Oh, okay. Normally what happens is you have problems with some part of the market. You have to sell because you're basically the prime brokers or whoever's giving you the financing says, your collateral is not sufficient. You have to post more collateral or we have to sell off some of your assets. So you're forced to sell. That selling itself pushes prices down more. So the next day you get a call saying, gee, thanks for selling those assets and posting that extra $100 million, but you know what? Now that stuff that was $900 million is worth $800 million, so you have to do some more. So you do it again, and it drops again. And now there's 10 other funds out there who are getting similar calls, and they're all selling, and you get this cascade. Well, what happened with Bear Stearns is the banks said, let's just stop right here. Let's not go through that process of making you sell, having the price be posted, which will lead all of our collateral to drop, which will hurt us, and will lead other hedge funds to then have the same problem. They all sort of decided, to sort of squelch the price discovery process, which may have been a good thing, given the alternative. But anyway, here's the problem that I see in a perfect storm scenario. Let me lay out what I think could happen. And this is sort of the perfect storm, so I'm making assumptions here that may not occur. But let's say interest rates go up. And let's say as interest rates go up, well, we don't even have to assume. Let's just let interest rates go up and let it be that alone. If interest rates go up in the environment we're in now, there'll be a lot of people who suddenly see their arms resetting, and they will see their $2,500 a month payments go to $3,000 a month or $3,500 a month, and they won't be able to afford it. And they'll turn around to try to sell their house, and they'll discover that this house, which they bought for $1 million, expecting it to go 1.5, is now worth $850,000. So either they cut back enormously on consumption to keep their house, or they foreclose, which makes housing prices drop even more, and that slows down the economy. So now you have a slowdown in the economy, and the people who were hoping that their income would move up by the time things reset find that's not occurring. So you have yet other waves of people who either have to foreclose or have to reduce consumption. Then on top of that, you have the baby boomers who started all of this in the late 70s. That's when housing prices started to really skyrocket, who are now on the other side. Instead of buying, they're at the stage of selling their houses. And they're selling their houses now in a market that's really depressed. And so either they sell for a lot less than they thought they would, or they stay in their house. But the key thing is that their major store of wealth for retirement has now been more or less wiped out. The house that they bought for $300,000 that's now worth $1.5 million is now back worth $1 million or $900,000 or whatever. So they have to go to the next step in the process, which is if I can't fund my retirement by selling my house, I guess I have to start to liquidate equities. And so now this is the mechanism then how the crisis, which will go in very slow motion, I'm talking about something that could occur over periods of years. But you already know that there will be dissaving through baby boomers as they go through retirement, which of course should have a negative effect on the stock market. But if housing prices drop, the dissaving will be accentuated all the more. And who's going to buy the stocks? Well, it's probably not the people who just had their houses foreclosed on. So stock prices then could drop. So you basically could have a crisis that extends out. And I have a blog that I do every now and then, and in it I have one entry of what am I worried about now? And I say this is it, essentially. But what I say there is that this is a crisis that would occur in what I call demographic time. or most crises that we see in the market, they're liquidity crises. They occur over days or maybe weeks. Even the crash in '87, it didn't last that long before things got back to normal. But this is something that may happen so slowly and gradually that even when we're in the middle of it, we won't notice. We won't say this is a crisis. It'll just, what it reminds me of a little bit is what happened with the Japanese stock market, where, for a whole generation of Japanese people, the stock markets don't go up, right? I mean, it's done nothing for a generation. And so these sorts of things can happen over a long enough time that we won't even notice it as a crisis, but the end result could be a substantial drop in housing prices, a slowdown in the economy, and finally having it ripple through to have a very negative effect on the stock market. Now that's, I'm not saying that will happen, but if I were going to sort of pose a reasonable worst-case scenario, that's what I would pose.
Thank you. Before we move on to Alan, there are some seats in the middle. So if the people who are sitting on the edges, if there's a middle seat in your row, if you kind of squish over, because we do have people standing in the back. Alan?
Well, I thought I would, microphone working? Microphone working when I'm here? All right. I thought I'd share with you, some observations, so to speak, from the trenches and try and describe from my point of view what I see happening now. I think if I had to put it into just a few words, there's a pipeline problem in the financial system, and in particular, the pipelines are those of the large banks and broker-dealers, and what they're stuffed with at the moment is a combination of subprime and loans. So let me take a second to explain where the subprime is coming from and what forms it takes, and do the same for the loans. The subprimes consist of all kinds of stuff. It's bonds based on subprime loans. It's the residuals of subprime loans. It's various pieces of structured credit, CDOs, that are based on subprime. It's single name CDS on various subprime-based bonds, and various pieces of ABX, the index that the prices of which Leslie was showing us a little while ago. And these things came onto the banks and broker-dealers' balance sheets in a lot of different ways over a long period of time, starting long ago, in their partnership with the mortgage lenders, and continuing up until the end of last year and the beginning of this year, when the warehouses that they had filled with subprime loans and with bonds based on subprime loans and CDS, et cetera, could no longer be turned into fresh CDOs. That was the beginning of the real problem. What happened, the way some people put it, is that the securitization machine, or the CDO machine, came to a grinding halt. So suddenly they have these things on their balance sheets. They've got these warehouses that are essentially the risk of the bank or the broker-dealer. So that's the subprime part. Now, more recently, that's been joined by the leveraged loan piece. And the leveraged loan piece got onto their balance sheets partly in a similar way. They're in parallel, sort of as an analog to the CDO machine, there's a CLO machine. Leveraged loans get issued, and then most of them have been finding their way into collateralized loan obligations, where you put a pool together, slice it up, and then distribute it to various investors who want to take various types of risk on this collateral. So the CLO machine hasn't quite come to the grinding halt that the subprime CDO machine has come to, but it's slowed down a lot. So the banks now have, in addition, CLO warehouses that are full of leveraged loans, and they can't bring these things to market. And then even more recently, there are what are called, loans on bridge loans and various other not quite issued loans, what are called hung deals. Some of them pertain to LBOs. Some of them are just leveraged loan deals that aren't necessarily associated with LBOs, that they just can't bring to market anymore. They've committed themselves to lending this money and getting it distributed, and they can't do the distributing anymore. So suddenly these guys have a lot more assets on their balance sheets than they bargained for. Now, they're subject to all sorts of constraints. They've got regulatory capital constraints, and they have internal risk management constraints. They can't have all these assets on their balance sheets indefinitely. So they have to start getting rid of it. Now, they don't have to get rid necessarily of these very assets. They can, in some other way, reduce the volume of assets on their balance sheets, or otherwise reduce risk. So they've been doing all those things. The two biggest manifestations that are kind of away from the initial driver, the things that make a lot of noise and have a lot of consequences, are, first of all, they have started constraining their prime broker lending to hedge funds, which they do in a number of ways, which I'll get to in a second. The other way that they do it is by piling into the best available hedging instruments. And those would include certain other CDS indexes that many of you have probably heard of, the IG, various forms of CDX. One is the IG, or investment grade. There's also a high yield index. Another very popular hedging vehicle has been the LCDX, which is a relatively freshly minted index of loan CDS. Notice that you have these indexes on derivatives that are on some underlying, which might itself be some complicated pastiche of stuff. So one visible consequence of this is that the spreads on these hedging vehicles have gone completely insane. And I'll quantify insane in a second. The other consequence that I mentioned is that the lending terms, particularly for hedge funds, have changed drastically. I'll say parenthetically, the lending terms for everybody else have been changing too. Another pretty visible thing is that leveraged loans were being handed out a little bit freely for the first half of this year, particularly the phenomenon of what's called covenant-light loans, which means that things that are normally in a loan contract just weren't there anymore, about stuff that the borrower was supposed to do, and ratios that he's supposed to maintain, and consequences if he doesn't. So the consequences in terms of lending were as follows. The haircuts were changed. This is now primarily in the the prime brokerage, lending to hedge funds. That's where most of this is happening. The haircuts changed. So if you could leverage something 5 times, it became 2 times, etc. Then in addition, and this is probably the single most consequential change, and it's a kind of a non-quantitative credit terms change, is the valuations put on collateral were drastically reduced. So in addition to only being able to leverage this item 2 times its value instead of 5 times its value has also been cut by 1/3 or by 1/2 or by 3/4. So the leverage terms changed really, really drastically. That was a huge thing. And then finally, it's almost just the icing on the cake, because it's probably the part that's least consequential, is the rates go up. The lending spreads go up. This is all highly, it's supposed to be highly collateralized, so it's always, in the neighborhood of Fed funds plus something not that big. The other thing that I want to take note of, just what's been going on lately, is it would be hard to overestimate just how strange the markets have been acting. I don't mean that in the 1998 sense. I mean that in a kind of smaller scale, just plain strange sense. One thing that I'm sure everybody here has observed is this new habit of the S&P to do something completely different in the last 45 minutes of the trading day than it's done all day long. Now, lately, this habit seems to have metamorphosed into this new habit of doing something completely different in the last 15 minutes of the trading day than it did in the last 45, the prior 30 minutes of the last 40. So there's very strange stuff. Then another strange thing, risk managers talk a lot, or their critics talk a lot about correlation breakdown. The things that you've been seeing the last couple of weeks kind of go a step beyond. All sorts of things move together one day and then just stop moving together the next day. Credit and equity is an excellent example. Credit and equity, you've got days where they are completely disassociated. You've got days where they are moving in perfect lockstep. You have one after the other. Sometimes in the middle of the day, the association or non-association suddenly switches. You have the same phenomenon going on, and this is a really big thing for hedge funds. The relationship between assets and hedges has been completely whacked. You have days where things move in lockstep with some hedge that you've appointed for it. Few of these things have really natural hedges. And then the next day, there's no association whatsoever. I think this has the market really spooked, and I think that even if things start to calm down now, it will take a really long time for them to calm down because portfolio managers basically start to lose faith in whether or not the way they've arranged their portfolios is even going to work from one day to the next. Just in this narrow, the sort of bread and butter mechanical stuff about how you hedge a book. So the market's been extremely strange. And then finally you have these discontinuous price moves that they come all of a sudden. They have nothing to do with news. They just happen. A lot of rumors. It's become a very rumor-driven market. So very, very strange atmosphere out there. Okay, so that's a couple of comments on what's going on now. I want to. How am I on time?
Why don't we leave where we're going? We'll come back
Okay.
for another round.
All right.
Can anyone hear me? Sure. Yeah, that title, the topic, Canary in the Mine, I believe has been with us. The canary's already been in the mine since, say, 2003, 2002. We also see these problems and kind of lay it at the doorstep of the hedge fund managers, the overlevered. But I sincerely believe that the problem and the causes can be shared and spread among several constituents. Investors, primarily, buyer beware. You ought to know what you buy. We are all part of it. And just before I go, my job here in Hedge Fund Development Group is to do due diligence on credit hedge funds, including structured credit managers. Add to that list will be regulators. Let's not forget Congress. They have a lot of power to change tax laws, to change certain acts that changes the way certain industries function. I believe back in Reagan days, 1986, tax law change sort of allowed mortgage originators not to take into their balance sheet a lot of the equity pieces that they end up with. Just to be clear, everyone in the chain of production in this enterprise makes money along the way except the end investor. Dealers are part of this issue. Let's not forget the rating agencies. And so to be fair, the blame can go along several ways. Recently we hear people asking, where is this risk? Well, the risk is fairly dispersed. No one knows where this risk is. The blame, similarly, can go a lot of different ways. But let's get back to the whole financial engineering aspect of this. I think it's very, very, rich and exciting. Most of us in this room probably did not put down 100% in buying homes. We all put down a small amount. Whatever that amount is, in my mind, represent leverage. If you're not using leverage, you ought to pay full buck for the house, and you don't owe the bank any money. My colleagues explained the process of how subprime gets from the loan that gets originated into a securitized asset. But this enterprise of securitization is really a novel concept of financial engineering and has allowed liquidity in mortgage markets and we all can today afford a home. Some of us do have home mortgages. We end up not even knowing who the original originator is. So you have all these issues, but there are a lot of factors involved. With that liquidity, created a situation where today we tend to blame subprime. But the good part of the process is that almost 75% of the mortgage market is good prime, solid borrowers with not silent seconds, good loan-to-value ratios. They put down payments. Subprime is part of it, but let's face it, Freddie Mac and Fannie Mae, after being cleaned up by the regulators of FAO, today have one of the best balance sheets. And as we hear in the news, maybe they might be coming to the rescue of actually beginning to buy subprime loans. So securitization in itself is not a bad thing. In my mind, what is really bad is you take something good and you mess it up. Regulators were asleep at the switch. No one is watching. How do you get someone who cannot pay their mortgage to pile into a house and take the same house, housing price goes up, they can lever it, buy another property as an investor and rent it without showing a single document of their income? That practice happened. Everyone watched it. We all knew it. No one complained. You turn on the TV, I don't know who knows about Ditech. You see their ad every day, yes. But all these things were happening. We all saw it. As investors, we piled into these managers. We loved them. They did well. Incredible liquidity was available to all of us. We can all remember after the dot-com boom, Greenspan lowering rates, you can predict and maybe trade off of Eurodollar futures on 25 basis point consistent rate cut in the Fed Fund futures. That went on, incredible liquidity. Other sources of liquidity coming to the market, we all know, petrodollars, commodities, Asia, all of that. The 10-year Treasury has not moved a whole lot since the Fed started raising rates. So we've seen this liquidity cycle in the market come and go. And in these situations, you have investors who typically are yield chasers, and I mean real money investors like pension funds, insurance companies. They want yield. They need to secure yield. But let's bring it back to the average person, grandmas and grandpas, retirees. When the Fed cut rates, they got to find yield somewhere. Any instrument that offered additional yield besides commercial paper looked attractive, they bought it. So the demand for yield forced a lot of people to look for securitized assets. Well, almost like taking a nickel and squeezing $1 out of it. These practices got ridiculous when you can take BBB subprime loans and create a AAA asset. Where do we blame the rating agencies? You got to get them involved. No institution such as pension fund or insurance company can buy an asset that is not rated. So, it's no surprise to all of us that today there are only a handful of companies that are rated AAA. But 99% of the total AAA assets are all securitized assets. I just learned something fascinating, and I could have, if you plot a graph of maybe Moody's, and please, if you work for Moody's, excuse me, no offense, but according to Financial Times, Moody's revenues in 2006, almost 44% were from structured finance. The actual company, brick and mortar companies that were issuing ratings, they earned almost 32% from it. Let's go back to 2002. Interesting phenomena happened. If you cannot compete, you buy it. There's a firm called KMV that discovered a way to take Merton model of how you price corporate bond risk and turn into an elegant way of really predicting probability of default. Well, Moody's was late to the party in terms of aggressively rating when companies were blowing up. This little company, great research guys, mathematicians, what have you, did a wonderful job. They went around New York, all these financial centers, explained to people how these things work. Today, they're owned by Moody's. That technology got shut down. Moody's earned 7% of our revenues from KMB. So there are all these systematic agents and factors involved in this market that makes me not want to blame the manager for leveraging. You know, let's come back to
Francis,
regulators.
I think if we could just take a hold and let Henny, because
Okay.
we've all got tons that we.
So I'll come back and, yeah.
Thank you.
I'm going to make my remarks very brief. Taking Leslie's injunction, the first thing I thought about was, what do we mean by the mind? Do we mean the whole financial sector, or do we mean the real economy? Can you hear me now? Good. So what I was saying is, I was wondering, you know, whether we should start out by thinking about the definition of the question most carefully. So I think the most important question is the canary in the financial sector mine or the real economy mine? And I think pretty much everyone on this panel has concerns that there is a lot of contagion from the subprime into the financial sector. And I'm going to go into why in a moment. And then the real question is, and the most important question is, does it spill over into the real economy? And is the feedback mechanism, the financial sector, then spooking the real economy? The other sort of terms that I want to clarify, because I think we use them interchangeably and I think it's a mistake, is to talk about the difference between liquidity and leverage. And I think there's so many cross currents in the market because there is still a lot of liquidity. I mean, I just came back from my first trip to the Middle East, and I met with the Kuwaiti Investment Authority and Abu Dhabi Investment Authority. I lived in Asia for 15 years. Let me tell you, there's a lot of liquidity. But what there isn't in the system, and that's where the contagion comes in, is that the leverage is leaving the system. So the supply-demand relationship is totally out of whack. And that's the problem. And it's very interesting to me when I go around and talk to the Wall Street dealers, and I am assured that they are doing the prudent thing, that they are taking leverage away from their hedge fund clients. And then they tell me the credit markets are going to bounce back. But if they are taking the buying power away from the hedge funds, that suggests to me that supply-demand is about to get even more out of whack. You know, and I think those are, you know, the ways that I see it at the moment. You know, supply-demand in the subprime market is going to have contagion just because there were a lot of investors who invested in both, and you've taken out a whole lot of the players in subprime. So all of a sudden, you've cut demand for corporate credit, and that's a lot of what's going on in the corporate credit market now. Then you have the rating agencies, as Alan said, changing the rules of the game, saying, you know, I mean, at the Wall Street Journal, I'm always asked to define PIK toggles and covenant light. And when the editors say, what is this? I say the shorthand is crap, basically, you know, and that doesn't work. But the fact is, these things, you know, are being thrown out of CLOs, and there's a dampening on the secondary market, and that is spooking the primary market. And I think if we think of things in terms of defaults, you're going to miss what's happening. You don't need defaults to spook the market further. All you need is downgrades. But I want to close by saying, because there is so much liquidity, the kind of stuff that you expect to have happen isn't necessarily going to happen. You know, all these hedge funds are going to the banks and saying, you know that loan that's sitting on your books? We'll buy it for 80 cents on the dollar. And Goldman Sachs is saying, we have a $20 billion mezz fund. We're going to buy that. We're not going to give it to you. We can play that game. So I think you're going to see a lot of cross currents in the markets going forward. And now I will turn it back to Leslie.
Well, great. You hit on one of the themes that's come up in some of the questions that we've received so far from the audience. And this is really for all panelists, but has this excess liquidity dynamics changed the capital markets for good, or is this a temporary phenomenon that we've been living in for the last few years? Yeah, the question was, has this excess liquidity phenomenon that we've experienced change the dynamics of the capital markets for good, or is it a phenomenon that will disappear? Go ahead.
I think, what Henny was saying about liquidity versus leverage, I think is a really critical point. The issue is not liquidity, it's liquidity that has come about through leverage. I think that's where the problem exists. And what we've seen, and Bernanke's made this comment, that hedge funds are, I may be paraphrasing him incorrectly, but from what I understand him saying is hedge funds actually have been good for the market because they provided more liquidity to the market, and that's led to lower volatility. Well, that may be true day to day, so long as the leverage that has led them to give that liquidity to the market is not tested. The result, the high liquidity, is good for the market. If I want to buy or sell, I don't have to push the price very far before it's like 10 million, little insects go out there and grab whatever's there. Prices don't have to move very much to find the other side of the trade. But if the liquidity is there because of leverage, then you have the mechanism in place for this kind of crisis cycle where there's a shock to the market. It forces highly levered players to liquidate, to raise capital, or to reduce exposure. That in turn drops prices even more, and so on and so forth. So if you can have liquidity is always good. The problem is whether it's coming simply through borrowed money.
If I can, there's a kind of a real economy piece of this that Henny alluded to, but it's important not to forget about it. I'm a little uncomfortable talking about liquidity because it means a lot of different things depending on who's saying, who's using the word and what the context is. But there's a real economy piece of this. It's referred to variously as the savings glut or consequences of the Great Moderation. There is a huge amount of saving in the world. It's depressed real yields. It's depressed implied volatilities, and all signs are that it's a real phenomenon. It's got to do with demographics. It's got to do with the fact that the world is getting rich. It's got to do with the fact that many developed countries find it in their interest, as bizarre and counterintuitive as it seems to us, to have very high savings rates and have trade surpluses by which they accumulate claims on the developed world. And all of those things will go on regardless of financial engineering and probably regardless of short-term monetary policy. And they're probably not bad things, and their consequences are very good things, namely that the world is the world is getting richer and has a lot less famines. So that's going to continue for some time to come.
Great. I think we'll take a 10-second break so they can change the tape. Henny and Francis to address this next one, which is, since we've already picked on Moody's, we'll pick on S&P this time. What explains S&P holding up while debt collapses? What explains S&P doing okay while the debt markets are collapsing? Not my question.
You mean the equity market, S&P equities?
Yes.
The index.
Equity market index.
Yeah.
Leveraged loans at 380, 390 off LIBOR. Why does the equity market keep sitting where it is? As opposed to, if you price the same spread out to junk into equity, you'd be sitting on 15% equity yield.
Right, and I think that might be part of the problem that probably caused big issues for maybe Solwood or some of the cap structure guys who were suddenly long equity, short debt, either short debt through CDX index, the high yield. But fundamentally, we all know that corporate profit has been reasonably good. My guess is that the intense LBO M&A activity that consistently rewarded the equity market with upwards of 25% premium really caused a bit of demand in everyone jumping in. You couldn't help but see value go up in terms of sectoral correlation and folks joining the party and pricing everything up. And I believe once the loan market got very serious and pushed back on these corp light loans with $300 billion deals, hung up on dealer balance sheet. Liquidity dried up. The equity market took that into consideration, knowing on forward basis that premium that they've enjoyed just will possibly dry up.
So that means you think the equity market will go down?
I believe the equity market will certainly be in sync with the credit market. Certainly you're pricing the same capital structure of a company. And so in times like this, one should not be out of sync with the other too much.
Nick, do you have a
I'd
perspective?
love to have Alan's take on it, but in terms of the private equity, I think that, the president of one of the largest private equity firms said that he thought, because of the private equity bid, he told me, stock prices are 20% higher. I don't think the market has yet dealt with the consequences of the fact that the private equity bid is going away. And, people who sort of dispute that contention of mine tell me, what a small part of the total market cap private equity firms are. But that's not the point. The point is that every company that reported disappointing earnings should have traded down, and it didn't, because until very recently, everyone thought that private equity would come in. If it was a good company, they'd come in because it was good, and if it was a bad company, they'd come in because it was cheap, and that dynamic kept the market from being cheap. One of the things that I'm looking at now is, the banks are on the hook for the financing of these deals, but I think the returns, the equity returns are totally being rewritten now, and you might see private equity deciding to walk away from some deals that don't make sense in the future. But I'd love to have Alan's take on this.
Let me give you two
I
answers.
think it's so volatile that, you'll just see such wild swings.
One answer, it's a very, and it relates to the pipeline problem. Until all of these credit assets get distributed to people who, at prices at which new investors will be prepared to hold them indefinitely, credit's just getting creamed. The people needed these hedging vehicles, and the hedging vehicles are what are driving credit spreads right now. So it's really a transitory phenomenon while the pipeline moves from a place where it was never meant to be into, at new prices, to places where it can stay forever. The second answer is equity valuations now are pretty close to their long-term averages. I mean, very long-term averages. You can look at different things, but if you focus on something as simple as a PE ratio, it's slightly higher than 100 years of data, and it's pretty much where it's been for the last couple of decades. But credit, even after the recent widening, is tighter. We don't have such long data time series for credit, but it's pretty much, even now, close to as tight as it's been during the period that you can observe. So if you had gone to sleep, say, 10 years ago and woken up today, what you would think is not that credit's gotten crushed, but that equity's done nothing while credit's gone to heaven.
Interesting. We've got lots of questions here, so let's move on. What does the panel think about whether or not most of these things that are supposed to be marked to market are marked to market correctly at this point?
Yeah. I think that, it's interesting. If you go back, I don't know how far back you have to go. I think of Howard Sosin and AIG, which is like in the 80s. The issues of mark to model used to be a big concern, and we found cases where there are discrepancies where one model was marking one way and then somebody else came in and marked them another way. Now we have mark to rating, which I think is even worse, because all we're doing now is we're marking to a different sort of a model, which is some sort of black box that I don't know people would generally consider as the best model. What I'd like to see, and this is actually a suggestion that came to me from the head of a hedge fund, and I'd like to attribute it, but I don't know if he would want me to attribute it, but it's not my idea, but I think it's a great idea, is it'd be nice if hedge funds, when they gave their returns each month, noted what % of those returns came from realized versus unrealized.
Amen.
I think that alone would go a long way towards, and then you could also add to that, and this would be my embellishment, how much of the unrealized is mark-to-market, mark-to-model, and mark-to-rating. I think this would be such a simple device to add and, to get a little more, under the covers, so to speak. While I'm at it, another thing that I think would be really nice to see from hedge funds is a time series of their leverage. I mean, I think it'd be really interesting to look at a time series of alpha over time and leverage over time. And my hypothesis would be that, leverage adjusted alpha has been dropping, and because of that, leverage has been being used to try to keep things pumped up. And if we find, we might, that it becomes more and more difficult to keep leverage up, it's sort of like, the air that you're using to keep that ball suspended in the air is starting to loosen and it's coming back to earth again.
Francis, do you have a perspective on how comfortable you are with the marks that people are doing in the hedge funds that you take a look at without talking specifics?
Right, without talking specifics, the sort of unrealized gains and realized gains reporting has been utilized by one of the structured credit managers that blew up. Every month you look at their report, they will tell you what their carry, net carry will be, unrealized gains and losses will be. But, I agree with Richard, you couldn't tell what it would take them to actually extract a realized gain until the asset is actually been put out to bid and sold. So in periods where they haven't sold anything, you tend to see higher unrealized loss or gain. And except in little time periods where there's strong demand for the asset, where they actually get into the market and liquidate and get a loss or gain. But be what it may be, these are the classes of assets. They're designed that way. And so my thing is, going in, you have to understand what you're buying. Back when interest rate swaps started, a lot of us taking dealer quotes had to sit down with dealers and get through how they get their forward yield curves projected. As things improved, we all accepted that. The index put up on the chart on the wall here has asset backs underneath them. But because the structure is simplified, that we can all get a sense of what the valuation is, it is accepted, even though the underlying assets are very, very illiquid. So my guess is one of the things that will possibly happen to these asset classes is a push towards more simplified structures that can allow transparency and ease of pricing. But, I'm not comfortable with mark-to-model, but that is what these structures are today.
Another question is, what about off-balance sheet exposures? Alan, you want to start on that one?
On the part of Wall Street firms?
Yeah, on the part of Wall
Yeah.
Street firms and on the part of insurance companies, pension funds, and others who might not be showing these because they're not marked to market.
Yeah, I may beg off on that one. It's actually not that relevant to hedge funds because we value everything at some kind of a fair NAV, and we don't worry too much about on and off balance sheet. But I'll use the opportunity to answer the question about how good
Sure.
these mark-to-market prices are.
Sure,
And
they're all good questions.
if you don't mind my answering the question by with a question. I know that's rude and it's terribly out of character for me, but the question that I would ask, and it's very, very relevant to where we're going next and what the next developments are going to be, is are the banks in distress, or have they had the opportunity to assume collateral at distressed prices? And I'll just let that question hang there.
Okay. On the valuation question, I just got another part to it, so maybe one of you wants to. Should companies not just get indicative prices for CDO tranches, but actual bid quotes to account for liquidity?
Since I'm the closest to you all, I think one of the big problems we have in the markets is that we only see the surface. We don't know the depth of the market. So when we see a price, we only know that that's good for 100 shares or one bond or whatever. This question may not be asking this specifically. I hope it is, because I think this is really the key question, which is how, if any substantial amount of some class of instruments went into the market, how much price disruption would occur? If we don't know the answer to that, we're always sitting, essentially walking on the ice and hoping it's not so thin that we won't break through it. And I don't know the way that we solve that problem. I mean, the only way you could do it is using the analogy of, the ice is take a hammer and hit it and see if it breaks. Is have somebody just suddenly hit the market with $5 billion worth of something and see what happens. But short of that, the analogy or the example that I actually use in my book, and I think is a very good one for this, is the summer of 1998 was a very low volatility, apparently highly liquid month or period for the swap market. It was like nothing was happening. But actually, it was smooth but very thin ice, because the reason nothing was happening and the reason there was low volatility is nobody wanted to participate, because they didn't want to be the first ones on the other side of what might have been the flood of paper coming with the closure of the U.S. fixed income ARB business at Solomon. So how can we know when we see a market that's very low volatility and we see indicatives or even a bid that looks good, how do we know the depth of that market and whether it really can support the weight that it might have to support if a number of large funds in a distressed situation have to sell?
We also have several questions getting at the issues of how is this going to affect pensions? If anyone wants to tackle that.
Now, I'll sort of tackle from the previous question about what is on balance sheet and off balance sheet and pensions and insurance companies. Leslie, I think, when you started, you sort of mentioned one of the issues being held to maturity accounts. My understanding is that a lot of these institutions have with FASB approval, have the ability to segregate certain assets into held to maturity accounts. And today, just a research report from, I believe, is it Bear? Yeah, probably Bear Stearns research report indicating that the AAA to AA tranches of CLOs and CDOs that widen out are very, very attractive to insurance companies, because the NAIC ratings requirements for those AAA to single A NAIC 1, they require the same regulatory capital. So to them, it doesn't really make a difference. However, what makes a big difference is what's on the held to maturity and the write-down rules. These institutions certainly are ratings dependent, and until the security gets downgraded beyond a certain level, they don't have to revalue something that's held to maturity and take a write-down. So until we see the rating agencies increase the pace of downgrade in home equity loans and RMBSs and CDOs related to those, you're not going to see suddenly insurance companies and pension funds selling these assets.
Thank you. And our next question, we have a couple of questions about what should the regulators be doing. Maybe Henny, you might have a perspective on that.
Well,
Speaking as an individual, not as a Wall Street Journal reporter.
especially given our new owners. I think my favorite quote from Rupert Murdoch, which I actually believe is absolutely dead right, is viability, is the road to freedom. I think it's very interesting that a lot of people in the market in the last few days had hoped that the Fed would cut rates. I think they were dreaming. Now everyone is hoping that Freddie and Fannie will be the salvation. I personally would hope that the Fed, is more focused on when the spillover effects in the real economy and have that determine their policy. I will say that the Washington Fed and the New York Fed, from my point of view, see things very differently.
Absolutely.
And the New York Fed, I think, is very focused on the risk of a collapse in the dollar if they cut rates. And, I think that then, institutes a whole nother change. My sense is at the moment, very concerned about inflation. Unemployment is not at 5%